Hello there. Welcome to my class. My name is Marcio de Paula, and I will be your instructor for today's lesson. Today we will be talking about QuickBooks Desktop 2020 Chapter 8. Working with balance sheet accounts and budgets. In this chapter, you will work with additional accounts reported on a company's balance sheet, other current assets, fixed assets, current liabilities, long-term liabilities, and equity. These other balance sheet accounts allow you to track the various assets owned by your business, liabilities owed by your business, loans that span more than 1 year, prepaid expenses, and owner/shareholder investments in a company. You will also work with the QuickBooks budgeting feature. By the end of this chapter, you will be able to create and use current asset accounts and transfer funds between accounts, track petty cash, create and use fixed asset accounts and items, record depreciation of assets, pay current liabilities and set up a long-term liability, create and manage equity accounts, set up and use QuickBooks budgets. Now, let's get started. Parrots Paradise Resort has received an offer to prepay their business insurance for 6 months for a discounted amount. Jimmy has decided to take advantage of this offer and will use QuickBooks to track this insurance prepayment. Jimmy has also just purchased a new boat for the resort. You will set up the boat as a fixed asset and set up a long-term liability account to track the loan. One company task that comes due periodically is paying the sales tax collected from sales of inventory. This tax will be paid from the current liability account, Sales Tax Payable. You will also explore how to work with budgets in QuickBooks for Jimmy. Working with other current assets. Companies use other current assets to help them match their expenses to income within the same reporting period. This is an essential aspect when you use the accrual basis of accounting, which means that expenses are recorded when accrued, not when cash is paid. This means that even if you pay a 6-month insurance policy or 6 months of rent upfront, you must expense it during the month that it covers. Expenses are matched with revenues during the same accounting period. This allows for a better evaluation of profitability and performance. How much did you spend to earn the revenue? Balance sheet accounts. Remember, the balance sheet accounts are the asset, liability, and equity accounts. You already know about many balance sheet accounts: bank, credit card, current liabilities, sales tax payable, accounts receivable, and accounts payable. Now you will focus on the remaining ones. Tracking supplies as another current asset. Some companies that operate using the accrual basis will track supplies in another current asset account. However, because of the low cost of supplies, many companies expense them when they're purchased. When tracking office supplies using an asset account, the transactions will look similar to those used to track prepaid expenses. A supplies on hand account will hold the purchased supplies until they are used. Once the supplies are consumed, you'll transfer the amount used to the expense account that tracks supplies. Notes receivable. Another asset you may see on the balance sheet is notes receivable. This account tracks promissory notes or loans you've issued to another individual or organization. They're classified as other current assets if they are to be repaid within a year, or other assets if it will take more than a year for the loan to be repaid to you. Notes receivable and accounts receivable are both assets for the company. The difference is that accounts receivable are the funds owed by customers, and notes receivable are based on a written promise to repay funds at some future date. The interest earned from notes receivable should be recorded in $70,000 interest income, another interest account, if they're not earned through a company's regular business operation. So, unless you run a company such as a bank or a consumer loan company, the interest is not earned as a regular business activity and should not be tracked in a standard income account. Paying down other current assets. After you place funds in another current asset account, you will expense them when they are used. Therefore, it's crucial to match expenses to income during the period in which they're used. Another term for this movement of funds from the asset to the expense account for an intangible asset is amortization. Amortization is simply the process of a balance decreasing over time. For instance, if you have a mortgage on company property, prorating the cost over 30 years is amortization. You can accomplish this transfer in the register window of the asset. Memorizing transactions. There are many transactions, such as the expensing of other current assets, that you will repeat over and over. You can have QuickBooks memorize these transactions to increase your efficiency. When QuickBooks memorizes a transaction, you can choose to be reminded about the transaction, not to be reminded and have it listed on the memorized transaction list, to have QuickBooks automatically enter it based on a set schedule. By default, QuickBooks will choose for you to be reminded of the memorized transaction. However, you must make sure to select one of the other options if you want the transaction to be listed or to occur automatically. When you create a new memorized transaction that you want QuickBooks to enter automatically for you, you can group it with other transactions you have memorized. Then, whenever you open QuickBooks, if you have memorized transactions, the Enter Memorized Transactions window appears with a list of those scheduled to be entered. This detailed list includes automatic transactions and helps you to stay on top of which transactions are slated to be recorded. You can use the memorized transaction list for those transactions you complete regularly. For instance, if you send an invoice to the same customer monthly, you can set up the invoice and memorize it. Then when you need to enter it, double-click it in the memorized transaction list. Tracking petty cash. Most businesses keep cash around for small expenditures. This is known as petty cash. For example, in QuickBooks, you set up petty cash as a bank account in your chart of accounts. Then, you fund it by transferring money from another account or keeping cash back when you make a deposit. Many businesses track petty cash expenditures at the end of the month with one journal entry. This text will show you how to track expenditures individually. However, you should be aware that they can also be handled in a different manner. QuickBooks offers two methods to record individual petty cash expenditures. Write checks method: choose petty cash as the account and use the Write checks window to record your petty cash expenses. The register method: enter petty cash expenditures directly into the petty cash register. The register method allows you to enter your petty cash expenditures more quickly, as you can tab through it faster. Writing off uncollectible receivables. Almost every business writes off money owed as bad debt at some point or another and removes it from accounts receivable. QuickBooks allows you to do this via two methods: treating it as a discount or using a credit memo. Regardless of the method selected, you will need to create an expense account to direct the bad debt. An example of when you may choose to write off receivables is when you learn that a customer's company has gone out of business. If you believe it's unlikely that you'll be able to collect for the amount due, you can decide to write off the amount owed by this customer as a bad debt. Your sales tax liability will not be affected if you treat bad debt as a discount, whereas it will be reduced if you use the credit memo method. This is why the credit memo is recommended when sales tax is involved. Remember that when an item is reported, its significance should be considered. To treat bad debt as a discount, not recommended for a receivable associated with sales tax, you enter it as a discount in the Discount and Credits window launched from the Receive Payments window. However, make sure that you use the proper expense account for the bad debt, example, bad debt expense. If you receive a partial payment from a customer, you can also choose to write off the extra amount in the Receive Payments window if you don't expect ever to receive the remaining balance. If you create a credit memo to write off a bad debt, you will use the other charge item to route the bad debt to the appropriate expense account, which will be debited. Accounts receivable will be credited. You can include both taxable and non-taxable bad debts on a single credit memo. Using this method, the credit memo is applied to the original invoice. Another way companies deal with bad debt is by treating it as an allowance. In this method, which follows the gap matching principle, a business can estimate the bad debts as either a percentage of sales or a percentage of receivables. This amount is written off by debiting bad debt expense and crediting an allowance for doubtful accounts account, a contra account because it's an asset with a normal credit balance. When an account is then determined to be uncollectible, the funds are removed from accounts receivable, it's credited, and the allowance for doubtful accounts account is debited. There are potentially three sets of accounting entries you would encounter when using this method. Current liabilities. Current liabilities are funds your company owes and expects to pay within a year. You've been collecting sales tax for your inventory sales, and now it's time to learn how to pay the collected tax, a current liability, to the appropriate tax agencies. Notes payable. Just as notes receivable track loans based on written promissory notes owed to you, notes payable are promissory note loans you owe to other entities. In this situation, you have promised to pay back the loan with interest by a future date. If the amount is to be paid back within a year, it's classified as a current liability. If it's due more than a year in the future, it's considered a long-term liability. There's a difference between notes payable and accounts payable. Accounts payable are amounts a business owes to an entity for products or services purchased from it and are usually due within a short time frame. In contrast, notes payable are based on promissory notes and typically due on a later date. An example of how a construction company may use notes payable accounts is to track loans for specific homes being built. Then, they will draw on the loans as the homes are built and repay them once the houses are sold. Sales tax payable. QuickBooks holds the funds in a current liability account when you bill a customer and collect sales tax. But of course, these taxes are never actually the property of your business, so you've been using a liabilities payable account as a place to store the taxes until it's time to pay them. When you're ready to pay your sales tax, you must do so through the Pay Sales Tax window. This ensures the proper liability account is affected behind the scenes when the payment is processed. When you pay sales tax, you must use the proper procedure or empty the sales tax payable account behind the scenes. The Sales Tax Liability Report. You can choose to run a sales tax liability report to see what funds you're holding in your sales tax payable account. This report will give you the values you need to file your sales tax return, total sales, taxable sales, non-taxable sales, and the amount of tax collected. The Manage Sales Tax Window. The Manage Sales Tax window helps you manage all your sales tax activities and reports by providing links to all the tasks you'll be performing when working with sales tax, from setting it up to paying it. Many situations could result in an incorrect amount in the Pay Sales Tax window or the Sales Tax Liability Report. For example, you may have charged a customer a tax rate for the wrong jurisdiction, or tax may have been charged for a non-taxable item. There could also be rounding errors, penalties, or credits and discounts that you need to consider. You can adjust the tax owed through the Pay Sales Tax window, or by choosing Adjust Sales Tax Due from the Vendor's menu. Don't use Sales Tax Payable as the pay from account. Instead, it would help if you used these types of accounts. For a rounding error, you can set up a special account or use miscellaneous expense. Some businesses opt to create a special income account for a negative error, or a special expense account for a positive error. For a credit or to apply a discount, use an income account such as Other Income. For interest due, fines, or penalties, use an expense account such as Interest Expense or Non-Deductible Penalties. If you adjust the Sales Tax Liability account, you will need to choose the adjustment the next time you pay sales tax to get the correct amount to pay. If a customer is charged sales tax for the wrong jurisdiction, you need to return to the original transaction and choose the correct sales tax item or group. If you charge tax on a non-taxable item, or vice versa, you need to adjust the invoice or sales receipt where the sale was made. This may require you to issue a credit to the customer who overpaid or reissue the invoice and receipt, or a statement to a customer who underpaid. Fixed assets. A fixed asset is one you don't plan to use up or turn into cash within the following year. Instead, a business uses fixed assets in a productive capacity to promote the company's main operations. In addition, fixed assets are depreciable, which means you don't expense the assets when you purchase them, but rather over the asset's useful life. The main types of fixed assets in QuickBooks are land, buildings, leasehold improvements, furniture and equipment, and vehicles. While the land is a fixed asset for a company, it is not depreciable. There is more than one correct way to set up your fixed assets in QuickBooks, so ask your accountant which method is preferred for your company. One method involves creating a fixed asset account for each major type of fixed asset, and then an account to track accumulated depreciation for all fixed assets. Another method we will use in this book involves creating a cost and accumulated depreciation account for each fixed asset. This results in the current book value of each asset being displayed in the chart of accounts and on the balance sheet. When you enter fixed assets upon creating a new company, you will debit the fixed asset account and credit the opening balance equity account. This account is created by QuickBooks when the first balance sheet account is created, so you have an accurate balance sheet from the beginning. If a loan is associated with the fixed asset, the loan amount will be entered in a long-term liability account and the equity or bank account difference. Depreciation. Depreciation provides a business with a way to match income to expenses. A fixed asset is used to produce income over a period of time, and depreciation allows you to record the appropriate expense for each accounting period. Many small businesses record depreciation transactions just once a year, but they can be entered monthly or quarterly if the business produces financial statements for those periods. Remember that expenses need to be matched with revenues. Accumulated depreciation. Each accounting period, a business records a depreciation expense for the fixed assets. These depreciation expenses accumulate in an account called accumulated depreciation, which is also a fixed asset account. Accumulated depreciation is a contra account, which means it offsets the balance of the related fixed asset accounts by entering a negative amount, so the book value is displayed rather than the original cost on the balance sheet report. You need to consult with your accountant before entering depreciation, and often she or he will enter it for you at the end of the accounting period. Fixed asset items. Fixed asset items provide a convenient way to track your fixed assets. After creating your fixed asset account and subaccounts, set up the fixed asset items through the fixed asset item list. These items help you consolidate the important information about each fixed asset in a convenient place. In addition, your accountant can transfer information from your fixed asset item list to the fixed asset manager, if they use that feature of QuickBooks. Fixed asset items do not affect anything behind the scenes. When you set up a fixed asset item, you indicate the account into which it's been entered. This doesn't enter it into the account or affect things behind the scenes. You must also complete the transactions to purchase the assets, pay for those assets, and set up the accumulated depreciation account to make sure it's appropriately tracked. If your accountant uses the Premier Accountant version of QuickBooks, fixed asset information can be pulled from your fixed asset item list into the fixed asset manager. This tool will help determine how to depreciate the fixed assets, and the amount that needs to be posted back to the company file as an adjusting entry. Remember that it should record them at cost, not fair market value, when a company purchases assets. So, for example, if you bought an item worth $750 for $100, it should be recorded at $100. Setting up a long-term liability. Most companies have to take out a loan for a fixed asset. A long-term liability account is used to track a loan scheduled to take longer than a year to pay off. In this section, you will create a long-term liability account to track a boat loan. QuickBooks provides a tool for tracking your loans, similar to the fixed asset item list for tracking your fixed assets. The loan manager allows you to set up loans based on the information you've entered in a long-term liability or other current liability accounts. In addition, the loan manager tracks the principal and interest payments without having to set up separate amortization schedules. You can also use the loan manager to compare different loan scenarios. There are a number of items you should prepare before you set up a loan in the loan manager. Set up your accounts. Set up any liability, example, $26,000 loan Everglades boat, expense, example, $63400 interest expense and escrow, if required, accounts that will be affected by the loan. Set up the vendor, if not already in your vendor list. Check previous transactions. If you're working with an existing loan, confirm that all the transactions related to it are entered into QuickBooks. Gather your loan documents. Have all your original loan documents handy, so you properly enter the opening balance and other information. Once all transactions are up to date and the loan is entered into the loan manager, you will be able to record future loan payments in the setup payment window. Equity accounts. Equity accounts reflect the net worth of a company. In Appendix A, Need to Know Accounting, notice the accounting equation teaches that the sum of the equity accounts is equal to assets, what you own, less liabilities, what you owe. Equity equals assets minus liabilities. An equity account has a normal credit balance. It represents how viable your company is, as it shows how much you would have left if you sold all your assets and then paid off the liabilities. In a sole proprietorship, the equity is what the owner has invested in the company. In a corporation, the equity is what the shareholders have invested in the company, capital stock. An owner's investment occurs when an owner deposits funds or other assets into the company or shareholders purchase stock. An owner's withdrawal of funds from the company is known as a draw. If it's a corporation, you will see shareholder distributions. At the end of the fiscal year, a business will show either a net income or a net loss. When the books are closed, this amount is transferred into the retained earnings account to clear out all income and expense accounts for the following year. When the fiscal year ends, QuickBooks automatically makes this transfer. QuickBooks creates the opening balance equity account when you first create your company. As you enter opening balances into the accounts, QuickBooks uses opening balance equity as the offset account so you can have a working balance sheet right from the beginning. You may need to enter a transfer between accounts if there's a balance in the opening balance equity account after all your new accounts are entered into QuickBooks. There are other times when QuickBooks may use the opening balance equity account, and an adjustment must be made. For instance, when you set QuickBooks up to track inventory and enter a beginning number of inventory items on hand, you debit 12100 inventory asset, and 30,000 opening balance equity is credited behind the scenes. Talk to your accountant about how to deal with equity transactions for your unique company. Remember that the first assumption of GAAP is that the business is separate from the owners and other businesses. Therefore, business revenues and expenses should be kept separate from the business owner's personal expenses. Budgeting and predicting in QuickBooks. QuickBooks includes a budgeting feature that allows you to create account-based budgets for balance sheet and profit and loss accounts. Budgets can be created based on a previous year's budget or from scratch, or if you've been using QuickBooks for a year, the actual figures of the prior year. After you've created a budget or a forecast, you will run a report to view the information. In addition, QuickBooks provides several reports that will allow you to view the information in your budgets and forecasts. Predicting the future cash flow. In addition to budgets, QuickBooks supplies you with a cash flow projector feature that assists with making future predictions. It allows you to conduct what-if analyses, as well as look at future cash flow or revenue. Projections can be based on actual figures from the last year or from scratch. The balance sheet in review. In this chapter, you've worked with a variety of asset, liability, and equity accounts, collectively known as the balance sheet accounts. The balance sheet is a report that shows the balances of all these accounts as of a specific date. Now that you've set up the majority of the balance sheet accounts, you'll run a report to take a look at how Parrots Paradise Resorts books are shaping up. That's all for today. Your next step is to review this chapter and get the exercises started. Thank you for participating in today's lesson. I will see you in our next session. And remember, if you don't know, askmarcio.com.